Welcome back, everyone, to the Money Mentor podcast. As always, this week, joined by Doc. Doc, it's my first time seeing you this year, so I suppose Happy New Year. Is that something we're still saying?
Well, perhaps, but we're 3 weeks in, so it's a little belated, but nonetheless, Happy New Year to you too, Chad.
Thank you.
It's going to be an interesting start to the year, of course, because a few weeks' time we have the first Reserve Bank meeting for the year. Plenty of chat around the prospect of an interest rate cut. A number of banks have been predicting that, but those predictions seem to change week by week. So I haven't checked this week, so they might have changed. But nonetheless, I think the likelihood of a cut has improved this year. I'm not sure it'll be early. Of course, it does depend on the data, and we have got some important data today to discuss in relation to what's going to happen with interest rates, and that is the latest labour market data, because it's not just all about inflation. That's not just the one thing the Reserve Bank looks at. It also looks at the performance of the economy generally, and importantly, a key measure of that is what's happening in the labour market. So we'll have a look at that today. We'll also look at the latest rental market data, and that's been interesting because we've seen an easing in what's been a spectacular growth period in rents across the board, really. But the last 6 months or so, we've seen an easing in that, which is good news for tenants, but it's still very much overall a landlord's market. We'll also look at the latest building approval data, talking about rents, because part of the issue that we have putting upward pressure on rents is that sort of undersupply that we have in our housing markets. We've just really stopped building over the last decade. Some sort of improving trends in terms of houses, not so good for apartments, and perhaps we do need more apartments than houses. But we're still well below that target that the government set a couple of years ago for new dwellings. And we don't have any auction data again this weekend, or this week, but that will start in another week or so when the auction markets start to ramp up, and we will get more auctions next week. But we'll have to wait the following week to get our first week of auction activity, which of course is very important. So enough of the introduction. Let's get into all this delicious data that we've got to digest. So we get our slide deck up. My Housing Market, of course, is my brand. I act as an independent commentator on the housing market. We do these podcasts in conjunction with our good friends at Infinity. Been working with Infinity for a number of years now, providing them with objective insights into the housing market, which is very important. We not only provide commentary, our commentary is supported by data, and we've got a nice giveaway that we offer all our listeners and viewers to the podcast every week in terms of the My Housing Market market data app. So look forward to that at the end of the presentation. But we are all about the current state and future prospects of housing markets, particularly the current state. And it's not just the raw data in terms of prices and rents, etc. We also look at all the key drivers of the housing market, and interest rates we've already discussed, of course. And if we do get a cut in interest rates this year, as is now perhaps more likely, certainly more likely, but it does depend on the data, that will be good news for homeowners because it will put upward pressure on house prices. Not so good news for those wanting to get into the market, particularly first home buyers. But nonetheless, we are seeing, housing markets that have had a good capital city markets that have had a pretty good run. Just about every capital city market's had a good run over the last couple of years. Just starting to head into those affordability ceilings, which does act to stop prices growth in our housing market. So if we do get an interest rate cut, it will act to refuel house prices, housing market activity. Not so much activity, but prices, because activity is still pretty solid. So that sort of means that if you're looking to get into the market, maybe you want to think about that now before those housing markets are refueled. But those decisions, most buyers are sellers and sellers are buyers. So It's more about investors and first home buyers that we look towards opportunities in the market with the prospect to changes in interest rates, which always do tend to generate change in price outcomes. So my housing market, let's have a look at this week's data. And of course, it is the week ending January 22nd. Chad, yes, you're 3 weeks late with the Happy New Year's, but that's all right, mate. I think a lot are still on holidays. And of course, believe it or not, we've got another holiday this weekend, which is the annual Australia Day. Is it still called that? I'm not sure. Australia Day. Well, it's coming up, the long weekend. And then we really are into the new year. So we'll really have to dust everything off and think, okay, no more holidays for a while. Although down in Melbourne, there'll be a holiday in about a month for their Labor Day celebration. But as I said, the week ending Wednesday, January 22nd, we bring you all the latest data on a weekly basis as soon as it comes up. In fact, I've just updated some data in relation to the labour market, which came through this morning from the ABS. So it is all about the latest data. This week we're going to look, as I said, at home rents, the labour market, December labour market, and November building approvals. So all the latest data. So let's have a look at the home rental markets. As I mentioned to Chad just before, we've had a period of the last 6 months following skyrocketing rents of some easing in rental growth and also some easing in what were record low vacancy rates. Still tight vacancy rates, particularly for houses. So still plenty of competition out there for vacant rental properties, but not as bad as it was. And we really couldn't have sustained those 20% increases annually that we were getting in some capital cities for rents, which is just crazy stuff. And of course, tenants just can't keep affording to pay, can't continue to afford to pay 20% more on an annual basis for rents, and that's part of the reason why we've seen rental growth easing is just those affordability barriers, because people just aren't earning, or tenants just aren't earning enough to cover those crazy increases in rents that we have had. So rental markets eased again. It is part of that ongoing trend, Chad, but we also have some seasonal aspects happening here. We do tend to see less demand for rental properties in December and January. No surprise, because it is the holiday period. People are less inclined to be making those sort of moving decisions. Also, in the student market, there's less activity because of school holidays, university holidays as well. So there is a seasonal aspect to this latest data for December, and we'll get a similar result in when we get the January data coming out in a couple of weeks. But nonetheless, it is adding to, as I've said, is a general easing in rental outcomes, both vacancy rates and rental growth.
If you don't mind, that when you talk about slowing rental growth, it's not necessarily rental prices moving backwards or moving lower. It's just a slowdown in the increase in rent. Is that correct?
Yeah, that's right. I mean, they're not going backwards. And growth rates in the markets that have been leading the charge, not just in rents but in prices, such as Brisbane, Adelaide, and Perth, continue to remain very solid. It's just part of that, energy that it is in those markets. So when we look at the latest data for house rents, and we can see there that a sort of mixed result. Sydney's still the most expensive place to rent a house, with median asking rents of $800 per week. That's flat over the month. Melbourne down a little bit to $598. Brisbane also slightly lower at 0.8%, but generally a flat month for overall house rental growth over December. You can see there the yearly growth rate still pretty strong there in Adelaide, up 7%, Perth up 7%. Sydney's still up nearly 7% as well, and Melbourne house rents have also increased by 4.8%. So we're still getting rental growth over the year, Chad, as you indicated. It's just not at those spectacular rates that we had earlier in the year. And as I said, a lot of that is because it wasn't sustainable, that growth, because affordability started to impact tenants. But when we look at vacancy rates for houses, we can see there that they're still low. Most vacancy rates are just under or below 1%, and these are still tracking record low results. The outlier there is Canberra, which has a 1.8% vacancy rate, which is still notionally in favour of tenants. Anything under, in favour of landlords. Anything under 2%, we're likely to see rental growth. Vacancy rates, it's once we get to 2% when it becomes more of an even market, and then we start looking at rent declines once we get to around about 3%. But you can see there some of those seasonal changes affecting vacancy rates over the month, with those vacancy rates on the rise or flat for houses. So still a pretty tough market there for tenants for houses. Rent's still growing more or less, but a little flatter. And as I said, two factors there: affordability and, of course, those seasonal factors that we expect in December. When we look at units, Sydney, similarly, the highest capital city to rent a unit at $750 a week. That's up 1.4%. But we have seen Sydney rents easing over the last year, down 2% over the year. But vacancy rates are now a lot higher for units than they are for houses. And I think part of this, and as I said, we've certainly got more so with units, seasonal impacts of the holiday period for higher education. And of course, as we've seen in recent shows, we're seeing a decline in migration, and the government has announced that student migration will be slashed. And maybe we're seeing some impacts for that, what has been a slashing in international student migration numbers, and perhaps that's affecting demand for units in some of the capitals, particularly the big education capitals such as Melbourne and Sydney, more so Melbourne, which does generate a lot of demand from students for rental properties, particularly units. And you can see their vacancy rates were up across the board for units over the month. Again, no surprise because it's December, but also because of less demand, perhaps from that declining demand from students as a result of those government initiatives to reduce international student visas. Over the year, again, the big movers: Adelaide up 10.6%, Perth up 6.7%. Melbourne units, which have certainly revived rents in Melbourne for both houses and units over the past year, up by 4%. So still some solid growth there in most of the capital cities for units, despite the fact that vacancy rates are rising. We await this year as they come out. Next month's results as they come forward. But certainly houses are still a tough ask for tenants, and more or less generally it's still a landlord's market for units as well. So if you want a copy of the latest My Housing Market rent report, there is a QR code. If you've got cameras handy with you, you can scan that code and it will take you to a PDF of the full December rent report from My Housing Market. So we've already had a bit of a chat about the labour market. This is very relevant in relation to interest rate decisions. We've had a significant fall in inflation, which has been the reason, the breakout in inflation was the reason we've seen, not just in Australia, but in most advanced economies, skyrocketing interest rates to try to dampen the outbreak in inflation. We have seen inflation falling in those, Europe, the US, UK, and here quite substantially. A lot of that has come through a sharp fall in the price of oil, Chad. So it's not just about higher interest rates dampening demand and putting downward pressure on prices growth. It's actually been, the adjustment post-COVID to those supply constraints that we had, particularly for oil. But the bad news from that is, even though we've seen a big decline in the price of oil, which has certainly pushed inflation down, we're starting to see some worrying signs that the price of oil is on the rise again. And data last week showed that we're above $80 US a barrel again. So, this is where the Reserve Bank's got to be a little careful that, you don't cut rates and then all of a sudden you've got to put rates up again because inflation is back. But we'll talk about that in more depth next week and the week after, because that will preview two things: the Reserve Bank's decision And of course, the latest inflation data for December that will be coming out at the end of next week. So we won't be in time for the podcast next week, but we'll certainly have a lot of discussion on that, because that'll give us a clearer sign as to what will happen with interest rates. But the other point to that is it's not just about inflation, it's about the strength of the economy. And a key to that, or a key indicator of that, is the labour market. And we have had a very strong labour market for a number of years now. We're not alone there. The US has still got a powerhouse economy. And it's calling into question, because how strong its economy is and the fact that it's seeing some upward movement in inflation, whether they should have cut their rates last year, which they did, and they cut them by 1.5%. Now, they were well ahead of Australia's inflation rate, and now they're similar to Australia's interest rate, but now they're similar to Australia's interest rate. But they're now talking about, hey, maybe, we'll have to hold off any more cuts until we see what's happening. So some concern there. So as I said, we don't want interest rates bouncing around up one month, down the next. That's the worst thing for the economy. So I think that the Reserve Bank's got to be quite circumspect about the data that it's analysing. But the labour market is important. We have had this booming labour market, as I said, for a couple of years. We've seen unemployment rates in the threes for a sustained period, and we haven't seen those sort of results since the early 1970s. And of course, that was a far different economy in Australia. Basically, one-income families made up most of the Australian economy. It's a lot different now. So getting a 3% unemployment rate again, 50 years later, under seriously different circumstances, is just reflects just how strong our labour market is. But I think ahead of any prospective interest rate cut, the Reserve Bank would be looking for some weakness in the labour market, just to add, because its brief is also to have a full employment economy, just to add to the improvement in inflation, if you know what I mean. So let's have a look. The jobless rate actually increased above 3.9% to 4%. Still a very low rate, that 4%. But the real issue with our labour market is the amazing job creation that's, we've created hundreds of thousands of jobs over the last couple of years. Again, up 56,000 jobs over December versus November. That is a big rise, and it followed 36,000 rise over November. So these numbers are just remarkable, that we keep creating all these extra jobs. We actually saw the unemployment numbers higher, which was a reason why we had that rise in the unemployment rate, is because unemployed numbers were up by 10,000 over the month, so more people out of work. But it followed a 27,000 fall the previous month. So we didn't even sort of match anywhere near the fall in the number of unemployed with the rise. So there's still a net gain of 17,000 fewer people unemployed over the 2 monthly period. So these are still very good numbers. But the icing on the cake was the participation rate, moved up to a new all-time record of 67.1%. The previous record was 67% set in September. Now, this is an important statistic, and just let me explain. The participation rate measures the proportion of the potential workforce that's actually working. So the potential workforce is made up of those who might have retired, those who are in business, etc. But we've now got a record. So we're taking more people out of the potential workforce, putting them into the workforce than we've ever done before. So it just shows how many job opportunities there are out there, and that people are moving from retirement or out of business into the workforce because those opportunities are there. Western Australia was the lowest state for unemployment at 3.4%. And we also had Perth as the lowest for the unemployment rate, which we'll look at in a minute when we look at the state breakdowns. So the jobless rate is still low, despite higher interest rates, which were supposed to dampen demand. That's why we have them there, so that people wouldn't be out there spending willy-nilly and pushing up prices. And migration, of course, because we've reintroduced hundreds of thousands of migrants into Australia, and yet we've still got this almost historically low unemployment rate and this very, very high, record high participation rate. And we're creating, tens of thousands of jobs every month. So this is not the circumstance. Usually when you're cutting rates, it's because you're a little worried about the economy and you want to give it a kick along, not when you've got such a strong economy. So this really does offset to a significant degree the improvement in inflation that we've had. So it's a bit of a sort of a headache for those from the Reserve Bank who are thinking that, okay, we look to have inflation perhaps under control, but we certainly don't want to have a half a percent, cut in rates or a cut in interest rates, whatever it might be, fueling economic growth, which will only create more shortages of labour, which will only force employers to pay more in that sort of a competitive environment. And the way they cover that will be to put up prices. So that's why the Reserve Bank would be, still wary about cutting rates with such a strong labour market there, because it could add to higher inflation down the track. So this is the chart for unemployment. We're actually exactly where we were a year ago in terms of the unemployment rate at 4%, and we're exactly where we were during the mining boom, the great mining boom of the early 2000s at 4%. So that shows you what are really, in the recent history, just how strong this unemployment rate is. And we have record high participation rate, and we're creating tens of thousands of jobs every month. As I said, this is certainly, not the environment you would typically think that lower interest rates would be introduced to, because they may, with labour shortages, only act to push up prices. So if we look at the capital city breakdowns for the unemployment rate, we have Perth there, the lowest at 3.3%. Brisbane not too far away, 3.4%. Good, strong result there for Brisbane. And Melbourne at 4.5%. So an outlier there, Melbourne. But when we look at the next data, we'll see that that's offset by jobs growth. And Melbourne has actually led in jobs growth over the past year. So even though the unemployment rate is higher than the other capitals, its jobs growth is the highest. So it's creating a lot of jobs down there in Melbourne, which is a very positive statistic. So let's not write that Melbourne economy off based on the unemployment rate, which is still, quite low there at 4.5%, but at 4.6% annual jobs growth, that's a very good result, and the best of all the states, even better than the low unemployment states of Perth and Brisbane. So that's our labour market data and inflation update. We've already seen the rental slide. Just to add to that, and this is a bit about inflation. When we look at the rents, this is a different chart for rents, which is part of the housing costs that the ABS uses for its CPI inflation data. We can see there, as I've said, a slight falling away, which we've had over the past year for rental growth. But this is the National Capital City Index over a quarter, and we can see the rental index is now starting to recover. So we're now starting to see signs which might be an indicator that those affordability barriers are being offset by higher wages coming through for tenants. But we'll watch out for this statistic over the next couple of months. So I mentioned we're also going to look at building approvals. That's, at the heart of our housing market imbalance in terms of higher rents and prices. Again, not good news over November, which is the latest data. Home building approvals down by 5.3%, which followed a 5.5% October rise. A lot of the bouncing around that happens with building approval data is because unit approvals are up and down over the month, because you can get a big development coming through, so that pushes unit developments up one month, and then the next month you don't have that big development activating unit approval level. So units were down 10.8%, but unusually houses were down 1.7% over the month, because houses have actually been the bright part of the construction activity levels over the past year. There's been a revival in house building, but it just tampered down a little bit over November versus October. The top, no surprise, again, we keep talking about Western Australia and Perth. It was the top performer for home building approvals, up 18.1%. So plenty of demand in Perth, and the Perth construction industry is responding to that with a surge in new homes. But overall, growth levels still remain depressed. Quarterly trend are low, but rising slightly because of higher house building approvals. So when we break it down there, I think the year on year is the important thing. You can see there over the month, houses and units were both down, but over the year to date, so that's the year to November, and then the full year to November versus the previous year. So those year on year and full year comparisons shows just the breakout that houses have had that increased quite strongly there over the year. But units, gee whiz, look at that, still heading south. So we're still seeing a big decline in the trends for and the actual data for unit building approvals. So this is the trend. You can see there just dipping away with those lower numbers over the month, but the trend has started to rise marginally, but the numbers are down compared to, this is the National Home Building Index, are down compared to where they were, down marginally a year ago. So what we can do, a little bit of math here, if we multiply that 14,000 by 12, right, what do we get? 168,000, correct? So roughly 160, that's what we're building at the moment, 168,000 per month, or we're approving. What was the government's target? It was 200,000 a year over 5 years, right? So that was a million homes, basically. But their target was 200,000 a year. We are, and that was a couple of years ago. They said that's their aspirational sort of target. Of course, they don't build them, but they put a number on what they expect. And I think the HIA was also talking about those sort of numbers as well. But gee whiz, we're still well short of that and falling 168,000, compared to 200,000. But let's remember, these are building approvals. They're not either commencements or completions, because they were talking about completions. So we always see approvals at a much higher level than either commencements or completions. So even it's well below the target of 200,000 a year, the current monthly rate. But we're talking approvals. So if you think about reducing that by maybe another 10%, you're really going to be pushing it uphill to get anywhere near those targets, which means, again, we're a country which has too many people and not enough houses. We're undersupplied in terms of matching demand for housing. And we're not alone, because this is the same problem in a number of other similar economies. So you can see there, this is looking at houses and units broken down. That was total there, that previous chart. And you can see the bouncing around in the darker chart there, which is units from month to month, the volatility. But houses have risen above where they were a year ago. So that's part of that improvement in houses nationally. When we look at the capital cities, Melbourne, as usual, leads the charge there for overall building approvals, home building approvals. I think the interesting thing there is when we look at house building approvals, and we mentioned Perth already. Perth is actually has the second most building approvals over this year, or over last year to November versus the same period the previous year. So that's a really booming housing market, Perth, and they're preparing a lot of new supply there to match that demand, which is good. And Brisbane also very strong there in third place. And interestingly, there, Perth and Brisbane well ahead of Sydney in terms of house building approvals. And of course, they're significantly smaller capital cities. So, again, reinforcing the tough gig it is when we think about the amount of people there are in Sydney versus the amount of people there are in Perth, that why we have higher prices and higher pressure on prices growth with that clear disparity between what's being built at the moment between the capital cities. So, and just looking again, this reinforces the home building approval changes over the year. Houses performing pretty well everywhere except Sydney over the year to date versus the same period the previous year. But Perth really roaring along, even for units, even though Perth has a very small unit market. So again, reinforcing a pickup in houses everywhere except Sydney, but units are down, up a little bit in Melbourne, up a little bit in Adelaide. So that's our story. When we look at the capital city trends, this is the story of why we have this undersupply, upward pressure on prices and rents. We've stopped building since 2016. In fact, on the annual trend, so this takes the annual building approvals from capital cities on a month-to-month basis. So this is the annual trend measured monthly, and you can see there that we're 36.3% lower than where we were way back in 2016. So, and again, we're not alone here. US, UK, Europe are all experiencing these same undersupply issues for basically all the same reasons: red tape, green tape, high house building costs, and restrictive planning laws that have all made this, a terrible problem in terms of being unable to house populations, meaning upward pressure on prices and rents. And this is the breakdown. We can see there that we've seen that revival in houses. That's the black bar chart. Houses are now picking up again after that big surge during the COVID period due to the previous government's home builder allowance. But look at units there. Units are just trundling down and down and down. In fact, the annual trend now is down 58% since the peak of 2016. So annually, we're doing 45,000 at the moment units building approvals in capital cities. And back in 2015-16, we were doing well over 100,000 a year. So that's a huge difference. And that's why we have such problems in our housing market. It's one of the key issues. So that's all the data for this week. As usual, we'll finish off with offering the My Housing Market Infinity Suburb Data app. So this allows you can take a scan of this QR code, which will or click on the link, which will give you a copy or lead you to the app. But let me be warning everybody, it is password protected. You have to get your password through the good folks at Infinity to get hold of what is a great app. We talk about the big pictures mainly here in terms of capital city markets, aggregating data. But this is an opportunity to find out what's happening on a suburb basis, real-time data. We look at asking prices and asking rents. So you can filter for price or rents. You can filter for the capital city region or the outside capital city region. On this screenshot, we're using Blacktown in Sydney as an example. You can filter for house, unit, or townhouse. Also, the number of beds, and there's the result that you can get as we have there. Not just the median price, asking price currently, but also the low and the high. So you know the boundaries for that particular suburban market and the number of properties that are for sale at the moment. And you can do exactly the same thing for the rental market. And we have an addition now to the app, and this is for investors particularly, and this will show you the top 10 yielding suburbs. So this looks at the return on investment based on current asking prices and current asking rents. So this shows you the annual return based on those measures over a year, and this then ranks the top 10 suburbs in each of those regions. Again, you can filter for unit, houses or townhouses, and for the number of beds as well. So not just the yield, the return on investment, but we also have the vacancy rate. You can get the vacancy rate, tells you what sort of demand there is in each of the suburbs, and you can compare that obviously with the suburbs. Also, the number of properties that are for rent and the number of properties are for sale. So there's lots of insight there that we provide, so you can take sort of a scientific approach to what's performing in suburban markets, and that's updated. That's updated on a real-time basis. So next week, December monthly inflation. We'll also look at the quarterly inflation, which is both very important. We'll have a big chat about what's happening there and the breakdown in relation to what's going to happen with interest rates. Drum roll. So a big show next week. Big data. Everyone will be looking at this data, the inflation data, and it'll be very interesting just to see what comes out, and we'll have plenty of background in terms of what's driving the particular factors of inflation, such as fuel, house costs, rents, etc., to discuss. We'll also have a look at the November retail sales, which is our last outstanding data set. So thanks, everybody, again today. If you want a copy of the report, that's the QR code. You can get a PDF copy of this report. Good luck with that. Happy New Year again to you, Chad. You know, I'll be
late
saying,
on I apologize, but hey, I was on a holiday.
I'll be saying Happy Easter any minute now. So, in fact, we'll probably start seeing Easter eggs in the supermarkets, anytime soon. So,
they're already. Retail sector chugs along, and it always will. Maybe that's where the job growth came from. We did come through that Christmas period. I'm looking forward to seeing what data you bring us next week as well. Maybe
will be very instructive. So good to chat again, and we're coming up for an important, every year is important, but a big year for the housing market. Will we get our housing markets refueled with an interest rate cut? Very interesting times again. The markets are still quite heady, and will we get a cut? We'll see. Okay, mate. See you next week.
I'll see you next week, Doc. Thank you once again.
Thank you.